Well, now all of a sudden I got a ton of risk. I've got inflation risk, I've got counterparty risk, and therefore I'm going to charge you a much higher interest rate. So that's why you almost always.
Ever wondered how to avoid a financial crash like 2008? With rising economic risks, experts like George Gammon are sounding alarms, saying start early. This looks like a 2008 financial disaster. So, what does he see? And how can we prepare to protect our finances? Let's dive into it. George Gammon, a seasoned financial analyst and commentator, warns that today's economic environment carries unsettling similarities to the conditions before the 2008 crisis. Now, you might be thinking, what parallels could exist between then and now? In 2008, a dangerous mix of high-risk loans, inflated asset values, and unchecked borrowing set the stage for a catastrophic collapse. Gammon believes similar warning signs are surfacing today. There's surging debt across sectors, high inflation rates, and risky lending practices that could push the economy toward a similar disaster. These are not just abstract concepts, they impact real lives, from jobs and home ownership to savings and investments. One of the major red flags Gammon highlights is the alarming level of global debt. In the past decade, debt has exploded, with central banks offering low-interest loans, making it easier for corporations, governments, and individuals to borrow. But here's the twist. Much of this borrowing isn't driving economic growth. Instead, it's often used to cover existing debts or support companies that would struggle without easy access to credit. These zombie companies barely survive on borrowed money and are highly vulnerable to any economic downturn. If interest rates continue to rise, servicing this debt will become more expensive, exposing weak links in the financial system. This mirrors the buildup before the 2008 crash, when unsustainable mortgage loans created a housing bubble that eventually burst. Alongside this debt problem, Gammon warns about inflation's role in the current crisis. Inflation, at its highest in decades, means everyday goods and services are becoming more expensive. When inflation climbs, the real value of savings decreases, and people's ability to buy things they need or save for the future gets hit hard. Think about this for a moment. If prices keep going up, people can save less and might start relying on credit to maintain their lifestyle, driving even more debt. Central banks try to control inflation by raising interest rates, but this strategy can backfire. Higher interest rates make borrowing more costly, which can slow down spending and investment. In 2008, a similar rate hike revealed the cracks in an economy built on risky lending, leading to widespread defaults. Gammon believes we're approaching that tipping point again, with rising rates threatening to expose over-leveraged sectors that can't handle the pressure. Now, let's talk about asset bubbles. Both real estate and stock markets are hitting record highs, but are these values sustainable? According to Gammon, current real estate prices are partly driven by low mortgage rates and limited housing supply, but this can change quickly. If mortgage rates go up, fewer people will be able to afford homes, and prices might start to drop. The same concern extends to the stock market, where companies, especially in the tech sector, are trading at valuations far beyond their earnings. These inflated prices aren't rooted in the actual value of the assets, making them vulnerable to sudden drops. In 2008, the housing bubble burst when prices could no longer be justified, and a similar crash could happen now if these markets face a correction. Adding to this storm are the ongoing global issues like supply chain disruptions and the economic aftershocks of the COVID-19 pandemic. These disruptions have made it harder for businesses to get products to the market, driving up costs even more and contributing to inflation. When businesses face higher costs, They might lay off workers or cut spending to protect their bottom line. This cycle can lead to lower consumer spending and rising unemployment, both of which can push an economy closer to a recession. So, if Gammon's warnings are accurate, what can people do? The most crucial step he advises is to start early. Early financial planning during times of economic uncertainty is not just about making smart investments, it's about protecting what's already there. One way to start is by diversifying assets. This means spreading investments across different categories: stocks, bonds, real estate, precious metals, and maybe even cryptocurrencies. Diversification helps protect against losses in any single market. For instance, if the stock market crashes, investments in gold or real estate might hold their value better, cushioning the blow. Another key step is reducing debt, especially high-interest debt. Debt can become a significant burden during a downturn, particularly if interest rates rise. Paying off debts now can free up cash and reduce financial stress in the future. By limiting debt exposure, people can protect themselves from the added strain that a financial crisis can bring. Gammon also stresses the importance of having a cash reserve. Cash provides flexibility. It's a safety net that allows individuals to handle emergencies without needing to liquidate investments at a loss. Starting early also maximizes the power of compound interest, which can be a game changer even in downturns. The earlier someone invests, the more time their money has to grow. Compound interest is essentially the process of earning interest on both the original amount and on any accumulated interest. Over time, this snowball effect can result in substantial growth. For those who prepared early in 2008, compounding helped their portfolios recover faster compared to those who panicked and sold their investments. Let's look at an example. During the 2008 crash, many who stayed calm and had planned ahead weathered the storm better than those who reacted in fear. The ones who had diversified portfolios, low debt, and cash on hand were able to either hold on to their investments or buy undervalued assets at low prices. In contrast, those who reacted by selling assets at a loss often missed the market's recovery. By starting early, diversifying assets, and staying informed, anyone can strengthen their financial resilience against potential crisis. What are your thoughts on this economic outlook? Comment your thoughts. If this insight helps, like, share, and subscribe for more content on financial preparedness.